Okay, good afternoon and welcome everyone to Options Education Session. My name is Tony Zhang. I'm the Chief Strategy Officer here at Options Play. And today is actually our first Options Play Canada webinar that we are running not for the TMX. Options Play has taken over the Options Play Canada tool. It's a really exciting time for us because now we're going to be launching a whole new set of tools for you over the next couple of months with regards to bringing the Options Play Canada platform alongside the US platform. So the screeners that you get on the US platform will be making its way to the Canadian platform. The portfolio tools, a lot of different things that are coming, trade ideas that are being sent out to you. These are things that we couldn't do under the TMX umbrella, but now that we are taking ownership of Options Play Canada, a lot of amazing things are in the works. So I'm really hoping to be showing you guys some of that stuff over the next few months. But today we're going to kick things off with an education session. This is just a bit of an introduction so that for those of you that are using Options Play, you have a better sense for how options can fit into your portfolio. You can expect weekly education from us going forward, something that we couldn't provide again under the TMX umbrella that now we're able to do so. So I'm really excited to be able to impart more knowledge to you guys, share more tools with you that we have built for the US markets that will be adapted to the Canadian markets, and show you how you can access that over the next couple of months. So before we get started, please everyone bring up your chat window, which is at the bottom of your screen. Feel free to type your name and where you're joining us from. I'm presuming almost all of you here are within Canada, but if you are outside of Canada and you're trading Canadian securities and you're interested in trading Canadian securities, welcome. I'm seeing a lot of Montreal, Calgary, Vancouver, Oakville, where I'm not actually familiar where Oakville is, and a few different places that I'm not familiar with within Canada, even though I've been quite a bit around all of the major cities within Canada doing events with TMX. Those have been fantastic to be able to do and meet many of you in person. I hope to be able to meet many of you in person going forward. But for now, we are going to be doing these options education sessions every single week to help you get up to speed on how options should fit in your portfolio. That's our goal. And then provide you with the tools that allow you to implement what you've learned during these sessions using Options Play Canada. So I'm really excited to get started, and I hope you guys are as well. Now, before I get started, what we are going to discuss today is purely for education and demonstration purposes. It is not a solicitation or a recommendation to buy or sell any of the specific securities that I'm going to use as examples during today's session. And as the title slide said before, what we're trying to cover here today is the number one options income strategy, hands down, not in Canada, not in North America, just hands down the number one options income strategy. The number one option strategy, hands down, because this is traded by more traders and more volume is traded in this single strategy than any other strategy. And I want to make sure you understand the strategy, you understand how you should be implementing it, and what to do once you've implemented the strategy in terms of managing the strategy. And this is the number one strategy, whether you're a retail or institutional. If you look at the institutional market in Canada, this is by far the most widely used option strategy by institutional pension funds, hedge funds, buy-side firms that are using this one single option strategy to add income to their long-term equity portfolio. So what strategy is that? It's a simple covered call. Now, how many of you are familiar with covered calls? Type yes into the chat window if you're familiar with covered calls. Type no if you've never heard of a covered call before, or if you're just learning about covered calls, type no. Yes, if you have and perhaps traded it. No, if you're just learning or you've never heard of it. Okay, so I'm predominantly seeing yeses. I'm seeing some no's, and I'm seeing some people that are saying just learning or just using them, or somewhat. Okay, so right now we're running the full gamut, but many of you have at least heard of it. So first thing I'm going to start off with is who is a covered call for, and then we'll talk about what is a covered call, helping you understand these cover calls, and more importantly, understanding what challenges you'll come across as you sell covered calls. I'll show you the real-time opportunities that you can find, and then end this with how do you manage a cover call trade before we open this up for Q&A here at the very end. But the primary thing that I want you to be able to walk away from this session is a clear understanding as to how can you add consistent yield to your portfolio, roughly 1 to 2% monthly yield to your existing equities portfolio. And remember, the key word here is existing equities portfolio and adding consistent yield. So how many of you currently have a stock or ETF portfolio, whether it's in a taxable account or a tax deferred account? Type 1 into the chat window if you have equities or ETFs in a taxable account or a tax deferred account. Okay, I'm seeing a lot of ones. So basically everyone here that has answered a 1, this strategy is suitable for you, and this is a strategy that you should be looking at, because if you're not using it, then you're likely giving up some yield in your portfolio. Now, there are risks, if you will, or rather, there are trade-offs with this particular strategy, and it's important to understand how you can minimize those trade-offs. And that is the key to what we're here to discuss today, because cover calls are not all the same. We want to make sure you maximize cover calls and get the yield without giving away upside. And that's really the key here. So let's jump right into it. Who is this webinar for? Many of you, as you said, answered 1, saying that you have equities and long-term investments. Now, when I look at the vast majority of portfolios, and I've been doing this for 17 years as a market strategist, I have seen just about every single trading strategy, portfolio construction, method for analyzing, selecting, trading stocks, different ideas that people have for how to maximize their option strategies, their stock strategies. I've seen just about everything under the sun. Despite that, I see that most of investors' wealth are tied up in long-term investments. These are stocks, these are ETFs that you have in your trading account, your investment account, your retirement account. These are largely stocks that you're not buying and selling actively. You're largely not even swing trading them. You're typically buying and holding these types of investments. Now, I tend to find that while this is not true for everyone, but the 80-20 rule quite applies here in this particular example. Most of the time, I see the vast majority of wealth is tied up in these longer term investments. And then we obviously have, especially for those of you that are here as Options Play Canada members, have some form of a speculative portfolio. You have views in the market, you want to express those views, and you want to take a little bit of risk to try to make some reward. Whether you do this for fun, whether you do this for profit, whether you do this just for an intellectual challenge. I've seen a lot of reasons as to why people choose to speculate their money more actively. But what we're here to talk about is this, right? Is this 80% of the long-term investments that you have that you typically don't put a lot of thought into, that you kind of just buy. Sometimes you have reoccurring buys that are set for you every single month. You don't even really think about them, and you're dollar cost averaging in the long run. That's what we're here to talk about, because most of the time we are here to talk about this, right? We talk about how can you make more money buying calls? How can you maximize your returns by buying calls or spreads or trading options? How can you minimize risk? Most of the time we end up spending our time focusing on that 20% of our portfolio. But what about the other 80%? This is what we're here to talk about today, right? This is the part of your portfolio that you don't really think about options being a tool for that portion of your portfolio, but that's what we're here to talk about. And there are a few rules that you can use to achieve a consistent income stream for this 80% of your portfolio. And generally, we're looking at about 1 to 2% monthly income in terms of yield. That's how much yield you can expect from this type of strategy. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. And yes, the slides and the recording will be made available to you after the session here today. So what is a covered call, right? Many of you have heard of it, some of you have not. So let's just make sure we understand what a covered call is. So a covered call requires you to own at least 100 shares of an optional stock or ETF before you can deploy a covered call position. That means that if, let's say, you own a stock that's not optionable, then you can't deploy a cover call. Or if you own less than 100 shares, you cannot deploy a cover call, because each call contract that you sell, it represents 100 shares. In order to offset the loss and the margin requirement of that short call, you need to own at least 100 shares in order to offset the margin requirement and the risk of a short call. What you're doing now, if you have both 100 shares and an optionable stock or ETF, what you're trying to do is you're trying to sell a call option against, or you're just simply trying to sell a call option. And what you're doing is you're using the stock or ETF position that you have as the collateral in order to receive the premium for selling that call option. Now, if you've never, if you don't understand option contracts and you're just learning about call options and what it means to buy or sell, we are going to be doing education. You actually can find some of our education on buying versus selling options to learn more about the concept of selling a call option. But an analogy that I like to make for those of you that are new to selling call options or understanding of selling call options is you can think of selling a call option as the insurance company selling you an insurance policy. And by selling you that policy, it gives you rights to do certain things, and it gives the insurance company an obligation to do things if you have to make a claim on your insurance policy. So selling a call option for you means that you have an obligation to do something. That obligation is to sell that stock at a specific price in the future. But because you've sold that policy, someone has to pay you the premium or the right to have the policy. And that's what you're doing as a cover call seller. You're acting like the insurance company, where it forces you into an obligation, but you're getting paid for that obligation. And that payment that you're getting is the income stream that you're getting. Now, let's talk a little bit about that obligation. That obligation is the obligation to sell the stock or ETF at a specific price. So we're going to talk about this with a real example. But basically what you're saying is that in exchange for some income today, I'm agreeing to sell my stock at a future price, at a specific price at some time in the future. Now, if you're a little confused by that, that's okay. It's hopefully by looking at a real example, that's going to make more sense. But does the concept of this make sense, everyone? Please type 3 into the chat window. And it's okay if it doesn't, but please, for those of you that if this does make sense, please type 3 into the chat window. We'll go through a real example if for any reason, if this is new to you or you're just taking a little bit of time to wrap your head around this. So I always say use a real example. That's the best way to learn. So let's say I own 100 shares of Shopify, and let's say I own it at $50. And as the owner of a stock, why do you own that stock? You own it because you believe it's going to appreciate in value in the future, and you are hoping that you'll be able to sell it at a higher price and make the difference between the two and make a profit, right? That's the whole reason you own a stock. So let's say you own 100 shares of Shopify at $50, and your goal is you want to sell the stock at $80. You have a target price of $80, and you're hoping that you'll be able to sell it at that particular price sometime in the future. So what can you do as an equity investor, and what can you do as an option investor? And I realize that I have a typo here already, so I'm going to try to correct it right now. But if as an equity investor, meaning you're not touching options, you have an $80 target price, what do? You place a limit order at $80 and you wait, right? That's the simple thing that you can do as an equity investor to say, I bought the stock at 50. I think it's going to hit 80. When it hits 80, I want to sell and take my profits. So as an equity investor, you place a limit order at $80. Guess what the $80 limit order does? Is it obligates you to sell your stock at that specific price sometime in the future. Does that sound like something we just learned in the previous slide? It sounds almost exactly like what we just learned with what a cover call does. So if you think about the language of an obligation to sell the stock at a specific price sometime in the future confusing, just think about what you have to do or what you're taking on in terms of obligations when you place a sell limit order. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. The obligations that you're taking on with a cover call is the same obligation you're taking on when you place a limit order to sell your stock at a specific price. You're saying sometime in the future when the stock hits this price, I want to sell, right? So when you sell a call option, you have the same obligation. But when you place a limit order, your risk doesn't change, meaning whatever you purchase it for, that's the risk that you take. Your potential reward is the difference between the price you sell it at and the price you purchased it at. And you're exposed to this stock until the stock reaches that specific price. And in the case of Shopify, there's no dividends, right? So you have nothing to show for your limit order other than waiting and hoping that the stock reaches your price, and you're exposed to any fluctuations of the stock price during that. So if the stock drops down to 30 in the meantime that you're waiting, you have to take on that type of exposure. Okay, so now let's pivot over to an options investor. What can you do as an options investor? Well, instead of placing a limit order, I can sell a call option. And in this particular case, let's say I sell the May, that tells me the expiration date. So I said obligation to sell the stock at a specific price sometime in the future. May expiration tells me when that option is good for. $80 tells me the strike price at which I have to sell the stock specifically for. Similar to the limit order that I place, I have to place an order for a specific price. But the difference between a limit order and a cover call is that a cover call pays me premium. Every single time I sell a cover call, I get paid premium. Just like every single year when you renew your insurance policy, you have to pay that premium. Well, if every single month you sell a cover call, so the buyer of that call has to pay you that premium. So that's the difference between a limit order and a cover call, is that you have the same obligation, but one pays you an income stream, the other one doesn't. So in the case of a cover call, as soon as I sell my cover call, the total risk of my position is immediately reduced by the premium that I collect. So instead of risking $50 a share on Shopify now, I'm only risking $49 a share. On the reward side, my reward also expands because my cost basis has declined now to $49 instead of $50. So my potential reward gets skewed further in my favor. And if, let's say, between now and May expiration, the stock doesn't reach $80, well, the call option has now expired worthless. I've kept my dollar, and guess what? I can sell a new cover call and collect perhaps another dollar. And that's when I refer to a consistent income stream. That's what I'm referring to with the cover call. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Now, I've spent nearly 20 minutes on these 2 slides for one very specific reason, because it's really important to understand this concept before we proceed any further. Once you understand this concept, everything else becomes a lot easier. Everything else just becomes learning some of the mechanics and executing on it. But before you can do that, you have to understand the concept. Now, I will say that I haven't been 100% accurate in my representation between limit orders and cover calls, because I think up till now I've compared them as if they're identical, and the only difference is that one you get paid and the other one you don't. But I want to clarify that they're not exactly identical. There are some differences that are important to understand, but I think it's first to if you think of them as equals, and they're very close to equals, that's the first way to learn the concepts, and then you can learn about some of the minor differences. So the first minor difference is that a limit order, once it reaches your specific price, your limit order gets filled immediately, right? So if the stock reaches $80 tomorrow, it reaches $80 next month, doesn't matter when. As soon as the stock hits the price, typically your limit order will get filled pretty quickly, especially if you have a relatively small number of shares. If you have a very large order, that's a little different story, but 100 shares, it'll get filled virtually instantly. In the option side, if the stock reaches your $80 price before expiration, well, guess what? The order will likely not get filled, or likely you will not take on the obligation of selling your stock at $80. It has to be, generally speaking, the stock has to be above $80 at expiration in order for the call buyer to execute their contract or execute their right to buy the stock, and subsequently forcing you to sell the stock to them at $80. So there's one very distinct difference. Limit orders get filled immediately. Cover calls need for the stock to be at or above that price at expiration date in order for the stock to be called away. So what you could have is a stock reaching, let's say, $81, and then a few days later, maybe declining to $76. And by the time options expiration comes around, the stock's below 80, you've kept your dollar, but you haven't sold the stock at $80. But the limit order would have sold their stock at $80 and taken profits. So that is one very distinct difference. And the second thing is that limit orders, you can place limit orders for any number of shares. So if you have 100 shares of Shopify, you can say, I'm going to sell 50 shares at $80 and maybe another 50 shares at $90. With the cover call, you have to trade in 100 share increments. So if you only have 100 shares, you have to pick one specific price that you're going to sell it at. And limit orders, you can place at any price. Cover calls, you have to pick at specific strike prices that are predetermined. Now, the options market are pretty good at listing a lot of different strike prices, especially for liquid symbols. But if you're trading something that's not very liquid, you may have strike prices that are pretty far apart. So you might have a strike price at 30 and the next strike's at 35. And those are your only choices. You can't say I want to choose to sell my stock at 32 if the only strike prices you have are 30 and 35. So those are some of the limitations that you have with cover calls that makes it not an exact direct comparison to selling a limit or placing a limit order. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. So I want to be very clear that there are very clear similarities between the two, but there are some distinct differences that you have to be aware of because they're not exactly the same, okay? Perfect, I see a lot of 6s. So now, like I said, that's the hard part. That's the part that, you know, if you've never heard of a cover call, those are the steps that you gotta figure out and learn and understand, okay, that's what I'm doing with the cover call. The rest of it is relatively easy. The rest of it is just mechanics. Okay, now that I've learned the concept, how do I implement it? How do I actually execute on this? So whenever you have a stock that you own, in order to sell a cover call, there's two things you have to pick. You have to pick an expiration date and you have to pick a strike price. And if you've ever pulled up an options chain, you know that there are thousands, some hundreds, sometimes thousands of potential choices to choose. And that can be quite overwhelming to figure out exactly where you want to sell your cover call. Well, this is really why we've done a lot of research on this. We've back tested this strategy, cover calls on hundreds of symbols over about 14, 15 years worth of data, test different expiration dates and different strike prices to give you a sense for where should you start your research and where should you pick your cover calls. And if any of you have ever struggled with picking a cover call, type yes into the chat window. I'd love to hear your feedback as to the struggles that you might have had with picking strike prices on cover calls, because this is probably the biggest contention that I get from investors saying, you know, great, I understand the concept of cover calls, but I never can quite figure out what expiration and strike price to choose so that I can actually get that consistent income stream. And the lack of ability to know what expiration date and strike price to choose from or to choose is usually what forces most investors to stop this specific strategy, because they'll do it for a while and they say, my stock got called away. I missed out on all this upside. I don't want to do this anymore because I've missed out on too much upside. So if that resonates with you, here's where you have to pay attention. Now, the good news is that it's really easy. It's really easy to pick the right expiration date and strike price. I'm going to explain to you why this specific expiration date and strike price is the key to consistent income in your portfolio. So let's do a little bit of a thought experiment. I'm just picking a specific stock, right? It doesn't matter what the stock is. I'm using Shopify as an example. Shopify at the time when I put together these slides earlier this week was trading around $61. So what I have is a few different choices, and I'm gonna make it easier for you. I'm going to tell you which expiration date is the based on our research, the optimal one to use. Let's just focus on the strike price, okay? Because if we had to guess what the right expiration date, I think we could be here all day long. But we've done a lot of research on this, and the optimal expiration date for selling cover calls is 45 days to expiration. So write that down, put that in your head. It's actually the case for a lot of option selling strategies, 45 days. But keep that in mind. 45 days is, generally speaking, the optimal expiration date for a cover call. It's the same for a lot of other option selling strategies. There are some modifications that you make for certain strategies, but for cover calls, credit spreads, a lot of them, 45 days is the optimal expiration. So now let's talk about strike price. Remember, the strike price is the price at which you're obligated to sell your stock. So I have a few different choices. The stock's trading at 61. I have $70, I have $74, and I have $78. I just have three choices here on my screen. Basically, what this denotes is how far does the stock need to rally before you sold your stock at that specific price. Now, if you choose a strike price that's relatively close to the current price, like $70, you're going to collect more premium, $2.72, which computes to roughly 4.5% of the underlying stock price over the 45 days. Annualize that out, that comes out to be about 51%. Or if you choose a 74 strike, that will net you about $1.25. That has a static return of about 2%, meaning 2% of the stock's value you're collecting in the next 45 days. That annualizes 20%. And lastly, if the stock rallies up to $78, that's going to collect the least amount of income, 77 cents. Whoops, that's a raw return or a static return of about 1.25%, annualized out to 12.25%. So, show of hands, and actually rather type it into your chat window. Which one would you choose? The 70, the 74, or the 78? Which one of those three prices do you think you would choose if you were selling cover calls on Shopify? Which cover call strike price would you choose? Okay, I'm seeing a pretty diverse set of answers. I would say 74 is probably the most common answer. Normally I put this up in a poll so I know exactly what percentage of people answer this. But I would say the vast majority of people are answering 74. I'm seeing some 78s and I'm seeing some 70s. So let's go through this. I think 74 as an answer is pretty common because I think a lot of people just think, oh, middle of the road, right? I don't want too much income. I don't want too little income. I want something in the middle of the road. 74 makes a lot of sense. And I think that, that theory is something that a lot of people can relate to. The $70 strike price, I also think I can relate to, because if you look at annualized return, here's 51%, here's 20%, here's 12%, right? If you're looking at that perspective, why would I choose anything other than the highest number, right? So I'm obviously going to go for the 51% annualized return. That sounds best, right? And then for those of you that choose 78, a lot of people will be scratching their head saying, why would you choose the one with the lowest amount of income? This is an income generating strategy. That doesn't really make a lot of sense, right? So I think predominantly the answers tend to skew between 70 and 74. However, based on our research, we've done a lot of research on this front. The overwhelming evidence shows us that the best cover call, the optimal cover call to sell, there's no ifs or buts, there's no clarifications or conditions, no conditions. The best cover call to sell is the one actually that generates the least amount of income. And that might sound really counterintuitive, but this comes down to one primary factor, which is the fact that if you decide to sell your stock at $78 versus, let's say, $70, what's the difference in terms of income between these two numbers? One, you can generate $2.72 of income, 51% annualized return. The other one, you generate 77 cents or 12% annualized return. The difference between those two numbers is roughly $2. Right? The difference between income on the more aggressive strategy versus the more conservative strategy is $2 extra worth of income. But what happens when the stock makes a big move? How much are you giving up for those extra $2? You're giving up a total of $8 in upside. Remember, why do you own that stock? Why do you own Shopify? Do you own Shopify because you're trying to generate income? No, you own Shopify because you believe that stock is going to rocket higher. Right? That's why you own every stock, is you believe that stock is going to is moving higher. Now, I will say, some of you will say, I own dividend stocks that don't really care about capital appreciation. That's fine, but that's not, generally speaking, most investments that you make in terms of equity. Most of equity investments, you're making it for the capital appreciation. So the reason that you want to be conservative on a cover call, meaning choosing strike prices far away from the current price, is because you want to prioritize capital appreciation over income. Income is actually a secondary part of cover calls. Even though cover calls is an income generating strategy, what you should be prioritizing is not income. What you should be prioritizing is the capital appreciation of the stock, because that's the asset you own. The reason you own that stock is because you think it's going to appreciate in capital. Let that stock run, because all it takes is one cover call that you sell when you're thinking to yourself, oh, I want to generate the most amount of yield possible. And that 1 month that you do that and the stock rockets higher to 80 bucks and you miss out on most of those earnings or most of those gains, that is what I can almost guarantee is when you're going to stop selling cover calls and say, that's not the strategy for me. And what you're giving up is a stream of income on the 80% of your assets because you got too aggressive on your cover calls to start with. If you got more conservative, and keep in mind, when I'm referring to these strike prices, I'm also giving you the deltas. The deltas tells you the percentage, a chance of the stock being above that price at expiration. So a 70 is a 30 delta, the 74 is a 20 delta, and the 10 delta is a 78. So when you choose strike prices that are roughly 10 deltas, that means 9 out of 10 times you're going to keep the 77 cents. You're going to keep roughly 12% annualized yield on your portfolio. Only 10% of the time, only 1 out of 10 trades, are you going to see the stock rocket significantly higher, and you're going to be able to keep your 12% annualized return and at the same time still be able to capture most of that profit, if not all of that profit, in the upside. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. When you're selling cover calls, a lot of people think about cover calls as this income generating strategy and they prioritize incomes. That is where that's where the strategy goes south for most investors. Even though it's an income generating strategy, remember the stock is the reason you own that stock. That's the asset. That's what you want to prioritize first. It's the capital appreciation first, income second. Because even when you prioritize income second, you're still looking at a strong amount of yield, right? Shopify pays you 0 dividends. You're gaining 12%. There's no other stock in your portfolio that generates 12% yield, especially on a stock like Shopify, a volatile, high growth stock. Yet you can generate an additional 12% and capture most of the upside if this, for whatever reason, earnings, the stock, just has a great month and generates a forward guidance that's fantastic and the stock rockets higher. You want to participate on that. How do you do that? You have to be very conservative on your cover calls. So whenever you're selecting cover calls, use a low delta strike price, roughly 10 deltas, 15 deltas. Whenever you pull up an option chain, most option chains has the Greek delta on it that you can use to pick your strike prices, but use a probability-based approach. That's how you can get consistency in this particular strategy. If you always pick 10 delta strike prices, you are going to have roughly 9 out of 10 cover calls expire where you keep the premium, and only 1 out of 10 calls where the stock gets called away. And that's okay. When your stock gets called away, that's a good thing. That means you were right. The stock made a big move and you were able to capture the profits of that big move. You should be happy when your stock gets called away. That 1 out of 10 times when your stock gets called away and you use a conservative strike price, you've done a great job at not only generating the maximum yield that you could out of that stock, but you're also now capturing potential upside and taking profits on that upside that you can now take those profits and buy some new stock that you think will appreciate in value in the future. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And I hope for those of you that have been selling cover calls for a while, this is a completely different way to think about and approach generating income in your portfolio, specifically with cover calls. Because I would say that most investors are not thinking about cover calls in this specific perspective and in this specific light. But based on our research, there's no other way to look at it. If you're looking at it but any other way, you're going to underperform, right? When we've looked at selling 30 delta calls, in the long run, you're better off not selling calls at all, because every single time the stock gets called away, you're missing out on upside. So that extra income that you're getting, the extra $1 or $2, is not offsetting what you're missing out when the stock does make a big run. So you're actually underperforming if you just bought and sold, if you just bought and held that stock. So cover calls should outperform buy and hold. If it underperforms buy and hold, then you're better off just buying and holding and not going through the whole headache of having to sell calls every single month. That's why we did this research, because there actually are very few conditions where selling covered calls beats buying and holding. One of the few criteria where cover calls beats buying and holding is if you get very conservative with your cover calls and prioritize that capital appreciation over income. And I cannot stress that one point enough, because if there's nothing else that you take away from today's session, that should be it. Okay? So, despite all of that, there are still some challenges that you're going to come across. Or rather, up till now, I think things have been pretty easy, right? Select 45 days, select 10 deltas. That's about it. That's all you need to remember with regards to entering the trade. Now, that's that part, I think, in my opinion, fairly easy. You write that down, 45 days to expiration, 10 deltas. Every single time you sell a cover call, you should be using that rule. If you do that, you should have fairly consistent income stream and capture most of the upside in the stock. Now, when it comes to managing that cover call, that's really where you have a few different scenarios. You have to understand the different options. And once the stock gets called away, you now have a bunch of cash, right? You've sold the stock at a profit. You have a bunch of cash. What do you do with it? That's another headache that you sort of have when the cover call position is going well or in your favor. So I'm going to refer to a specific thing here in the next few slides. I'm referring to a roll. And just to be clear, a roll is a technical term for something that's really simple. It's simply buying back a cover call that you currently have and selling a new cover call. And when you do that in a single order, especially a multi-leg order, and I know in Canada, a lot of brokers, you can't do multi-leg orders yet. I do know that a lot of brokers are investing in this particular tool. So hopefully in the next year or so, you'll be able to see this at some of the most major banks in terms of being able to execute these multi-legs. But if you trade with Interactive Brokers or Questrade, you can do this today, where you can basically close a cover call and sell a new cover call in a single trade. You don't have to break up the two into two separate trades. If you're trading with a broker right now that only offers single leg, you have to trade these separately, and that means you have execution risk where one side gets filled and the other one doesn't, or vice versa. So when you do this in a multi-leg trade, you remove that execution risk, you're reducing transaction costs, and you can do it all in one trade. So that is something that I do recommend. If you have a broker that allows you to do multi-leg trading, roll your cover calls as opposed to closing one out and selling another one as two separate orders. So let's talk a little bit about if the stock rallies significantly after you sell your cover call, what do you do? Now, this is the scenario that I see a lot of traders tend to panic around selling a cover call and the stock rallies, because the short call that you've sold shows you an unrealized loss, right? And you're thinking to yourself, if I didn't sell this cover call, I wouldn't have this unrealized loss. So I've basically gotten myself into a spot of trouble by selling a cover call. Well, this is really where the best thing to do is not panic. Remember, any losses that you have in the short call is offset by the long stock position. So this is the only option strategy where you're not adding additional risk to your portfolio. Every other option strategy you take adds more risk to your portfolio. The only exception to that is a cover call. Cover calls do not add any additional risk. So whatever risk or whatever downside you see on the short call, you've made back on the stock position. So it's completely hedged. So that's one thing to keep in mind. So whenever you see a stock rally significantly after you sold the cover call, the best thing to do is to do nothing. You want to hold that cover call. You want to hold that cover call and either let the stock get called away at expiration, or if, let's say, for whatever reason, new information has come out, you used to have an $80 target price on the stock, but now you think the stock can go to 100, right? So before the new information come out, you were happy to sell the stock at 80, but now you think the stock can run to 100. What do? What you do is you still hold the position. You still hold the short call until the last 1 to 2 weeks. That's when you want to roll your cover call. So you might want to buy back the $80 call option and then sell maybe a $100 call option, because that's now your new target price. But the rule here is that you don't want to roll too early, because if you do that, you're going to lock in a loss for your cover call, and that's not something you want to do. You want to wait till the last couple of weeks, let all of the extrinsic value or most of the extrinsic value evaporate and decay, and that's when you want to buy back the call option and then sell a new one. And again, a lot of people think of the stock being called away as a negative, right? Because now I've missed out on upside. But remember, you're never going to be able to sell the stock at the absolute peak. That's just never going to happen. And it doesn't matter whether you're using a cover call or a limit order, you're never going to be able to sell your stock at the absolute peak. So the fallacy of, oh, I didn't get a higher price is kind of this false hope that we all have of being able to sell the stock at the absolute high. So keep in mind that when the stock gets called away, that's a positive, right? You basically set yourself a target price. The stock reached that target price. You should be happy that you've made a profit, and now you can take those profits and buy a new stock, perhaps at a lower valuation, a lower price that you now think is going to appreciate in value going forward, right? Buy low, sell high. What you're doing here with a cover call is you're selling high, and now you have the opportunity to take that cash and buy low again for a new stock. That's what we call the wheel strategy. A lot of people get sucked into, oh, the stock's going higher, let me buy some more, hoping it's going to keep going higher. Well, that's going to last. That's not going to last forever. So change your mindset on this. Stock gets called away, the stock rallies, sell high, and then take the cash and buy low. Make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, second scenario, you sell the cover call and the stock trades sideways. This is really a non-event for a cover call position. There's a lot of things that you can really do, but the easiest thing to do is just to let it hold it to expiration. When you hold it to expiration, all of the premium that you collected, think about an insurance policy that you've sold that someone never has to make a claim on. You keep 100% of the premium that it paid you. That's basically what happens when a cover call expires worthless when the stock trades sideways. Now, for those of you that are more active, you can, as you get closer to expiration, basically start rolling that strategy. Usually, when you make about 75, 80% of the total premium, so let's say you sold something for $1, it's now trading at 20 cents or so, the stock's not moving anywhere, buy back that call, sell another call option, another 45 days out. If you want to be more proactive, you can do that. But like I said, if let's say you're not very active, you don't want to manage these really actively, this is not a strategy that you have to manage actively. You can simply let it expire worthless. The only thing you have to remember if you're going to let it expire worthless is to make sure you come back on Monday morning to sell a new cover call. I tend to find that if you let things roll off on their own, you'd sometimes forget Monday morning, oh, I have to sell a new cover call. If you have a proactive strategy or reminder that 2 weeks before expiration or a week before expiration, I'm going to roll all of my calls, then you never have a gap where you forgot to sell new cover calls if you're not generating income. This way you're always generating income, because as you approach expiration, you don't let it expire. You just automatically sell a new 45-day option and continue that income stream. Does that make sense, everyone? Please type 4 if that makes sense to you. And lastly, cover call scenario when the stock declines significantly. So remember, you own the stock because you think it's going to decline. You're going to, because you think it's going to appreciate value. But if the stock declines, this is really where, yes, you've made a lot of money, or you've made most of the profits in your cover call very quickly, but you have probably a much larger losing position from the stock position that you have. So from a cover call perspective, roll down your cover call early. This is the only time when you can take action immediately. So let's say you sell a cover call and 2 days later, the stock drops significantly. You might be able to buy back that call 2 days later at pretty much full maximum profits and basically sell a new cover call. This way, you're basically generating more income immediately rather than holding the rest of the expiration to make very little profit that's left anyway. So you want to lock in your profits and potentially sell new cover calls. But the caveat here is your priority is not cover calls in this scenario. Your priority is the stock that you own. Meaning, if you own a stock and the stock drops significantly, you should be thinking to yourself, and this is whether you sell cover calls or not. This is if you were just an outright equity investor, you own a stock, the stock declines significantly. You should be asking yourself, do I want to remain invested in this stock? I can't tell you enough in my 17 years as a strategist, how many people hold on to stocks because they don't want to take a loss. That's a terrible reason to hold on to a stock, because what you're not thinking about is the opportunity cost of what you could be doing with that cash somewhere else, right? Stock drops significantly, bad news comes out and the stock, tanks, right? Maybe you think that the stock is going to recover. And if that's the case, no problem. Keep holding on to the stock, keep selling cover calls. But A lot of the times when bad news comes out, that means new information has come out where you might be rethinking, is this still a good investment? A lot of times you'll find that new information that comes out that tanks a stock should reframe your decision as to whether or not you want to hang on to this stock, right? Maybe you had a really optimistic growth projection of this particular stock, but new information has come out that has shown you that that's not happening anymore. Well, guess what? Perhaps what you should be doing is not continuing to sell cover calls, not thinking about how do I turn my loser into a winner, not thinking about how do I hedge my downside. You should be thinking about selling the stock because that cash is better applied somewhere else to a new stock that you now have better growth perspective on. And that is something that a lot of people don't talk about with the call, because again, a cover call, while an income generating strategy, is an income generating strategy on assets that you own. You should be prioritizing your assets, not the income. So when you have a stock that drops significantly, especially one that you sell cover calls on, but even on ones that you don't sell cover calls on, ask yourself, should I remain invested in the stock? You should not be afraid to take a loss, because it means that you're reallocating that capital somewhere better, somewhere that has a better chance of getting back to, getting your money back, if you will, rather than holding onto the stock, hoping that that stock gets you back to break even. I cannot, again, stress to you enough how many times over the last 17 years of doing this, I see customers that tell me, I'm just hanging on to this stock because I had a loss. I don't want to take a loss, so I'm going to hold on to it. And sometimes people hold on to a stock for 10 years, hoping to get it back to break even. It just doesn't get there, and it just kind of sits in their portfolio. It's this black sheep that sits there. If anyone can relate to that, please type yes into the chat window. I highly, highly recommend that if you have any of those stocks in your position, in your portfolio, take a few minutes and rethink about other opportunities that you see in the market, and should you be potentially reallocating that capital to other opportunities, because it's not just about taking the loss, it's the opportunity cost that you're missing out on by leaving this dead capital sitting there. And I see a lot of you have answered yes, so hopefully that struck home and makes you think a little bit tonight when you're looking over your portfolio as to what to do next. Okay, with that covers what I wanted to share with you here today. Like I said, this is the beginning of a new journey. We're no longer under the TMX umbrella. They have been fantastic partners to us over the past 5 years. We've been able to come to you, and many of you now know us in the Canadian space because of the TMX, and I have a lot of gratitude and thanks to the TMX for doing that and being fantastic partners. We have just decided to move in different ways, but this has allowed us to actually improve the platform without being under the TMX umbrella legal compliance framework that we had with them. It really allows us to do things the way that we want to do it, the way that we do it in the US. So there are going to be a lot of things coming from us over the next few months. I'm really excited to share those things with you as they come out. And we're going to do it in this forum where we're going to be able to provide education to you. We're going to be able to starting to send trading signals, something we didn't do in the past. More education, more scans that we've done in the US markets that we're going to apply for the Canadian markets, IV rank, liquidity indicators, all of these things that are coming in the coming months, including our portfolio tool. This is going to be a really important tool in helping you manage your options positions. We're working with a lot of new Canadian brokers as well, so really excited about all of that coming online in the next few weeks. With that, I'll open this up for Q&A. And there's a Q&A window and there's a chat window at the bottom of your screen. If you don't mind, please type your questions in the Q&A window and I'll try to answer your questions in that order. Okay. Yes, this is recorded and the slides will be made available to you afterwards. Zuhair is asking, is there a separate subscription fee for the Canadian version or one fee for both US and Canadian? So once we are fully detached from the TMX umbrella, which we're doing here in the next couple of weeks, there will be a fee to the Canadian version of Options Play. It will be a reduced fee relative to the US version. There will be a 30-day trial so that you can test everything out before you have to commit to a subscription. But like I said, we're adding a lot of the services that we have on the US side, so there will be a fee. At the moment, we're targeting 35 USD per month and $350 for the year to get access to the Canadian version. But like I said, we're launching in the next few weeks. You're going to have a 30-day trial past that. So you're looking at towards the end of May before you have to commit to paying in order to get access to everything. But in the meantime, you'll have access to everything for free. You'll be able to test things out before you have to commit to that. The question is 45 days the optimal expiration on this recommendation, and any of your references to 14 to 50, is this specific only to the Canadian market? No, this is applicable to both the US and Canada. So we have back tested both markets for this. With 45 days out for a call option, you may be exposed to an earnings date. Is that okay? Yes, it is okay. Some of you have preferences not to sell during earnings. I don't happen to have that preference because many times earnings is the catalyst that pushes the stock higher and allows me to sell my stock at a profit. So I don't mind doing that. And you always collect more premium during earnings season because implied volatility is higher, there's higher uncertainty. So you get that extra income, which kind of offsets the risk to some degree of that big move to the upside or even big move to the downside. So especially because if you think about it, stocks can equally move to the downside on earnings, right? So what I like to do is to offset some of that additional risk by collecting more income. So think of it like an insurance policy that you're selling during a more volatile time, right? Imagine someone selling you an insurance policy during earthquake season, or I'm sorry, not earthquakes, during forest fire season, right? If you're trying to buy insurance during that time, you might see your insurance premiums be elevated. Doesn't mean that that's going to happen. It just means that a higher probability of that happening. So as a seller, you're going to collect more premiums. So during earnings season, you're going to collect more income. So that's why I like selling during earnings season. Options are in 30-day increments. So for 45 days, you start 15 days into a term. So you're not starting 15 days into a term. So you're basically, if let's say the next options expiration is 30 days out. So I will say that you're not going to be able to always get exactly 45 days, right? Just get as close as possible to 45 days. That's what you're shooting for. You're never going to get exactly 45 days, but get as close as you can. Canadian stocks are not very liquid. Does the call strategy apply? Yes. You'd be surprised that there's a sufficient liquidity in the top roughly 60 names or so in the in the top 60 names or so, and that's predominantly where I would say most of you have your long-term equity holdings are in these types of more blue chip liquid names. So for those, you're absolutely going to be able to sell cover calls, and remember to use limit orders. Use limit orders near the midpoint. Move your pricing, a few pennies down at a time, but try to get as best fills as possible. This ultimately, as a retail participant, you should not find liquidity to be a problem. If you're trading tens of thousands of shares or 100,000s of shares or hundreds of contracts, you might have liquidity problems, but market makers are there. You should be able to get filled on your 5 to 10 lot cover calls with no problems on most names. Peter's saying, if you have a cover call that's deep in the money and you have the cash rather than roll, what about buying another 100 shares and sell a new call and let the first one be assigned? Then you don't buy back the call at a loss and you aren't paying for the present time value. So Peter, I think, I haven't thought through exactly your scenario, but I think what you're saying, and actually I take this back. I don't know this for a fact in Canada, and maybe some of you can tell me if this is the case in Canada, but at least in the US, there's no obligation to deliver the, tax lots is not a first in, first out rule, right? You can deliver any tax lot. So if you have the cash to buy another 100 shares, you can deliver that 100 shares from a tax lot basis and not have to pay the capital gains on your original low cost basis stock. So in the States, and if anyone can verify if this is true in Canada here as well, if your stock gets called away on a low tax basis position, you can just purchase more stock on Monday and deliver that from a tax lot perspective. Peter, let me know if that's what you're referring to. I think you're talking about doing this kind of before the calls expire, but you can do this even after the calls expire as well. Does it make sense to buy a stock that you are not bullish on, specifically sell cover calls at a low strike price and generate the maximum yield? So, Carlos, if you listen to what I said, the cover call strategy is for stocks that you are bullish, or stocks that you own, and you own stocks because you think it's going to go higher. There's no reason you should be selling a cover call if you're not bullish on the stock. The only caveat to that is if you're not bearish on the stock, meaning you think the stock is reasonably priced, you're fairly confident the stock's not going to drop, yes, you can sell cover calls, but I don't think that that's the best use of your capital. I think you're better off because you're going to find the same amount of yield, or generally the same amount of yield on a stock that you're bullish on, because yield has nothing to do with directional view, right? So I think that you prefer to buy stocks that you're bullish on rather than stocks that you're bearish on, or even neutral on. Okay. Can you sell an option if you do not own any stock and you have cash? You can, but you have unlimited risk. So it's not just about the amount of cash that you have, it's about the risk that you're taking, because the risk that you're offset with the long stock is offset. If you just sell a naked call option, just because you have cash, you're still taking on unlimited risk. So I would not sell naked calls even if you have the cash. Does 10% delta also apply to dividend paying stocks? I generally think that it doesn't matter what the stock is, because dividend paying stocks are just low volatile stocks. So 10 deltas will naturally be a closer price than a more volatile stock. So 10 deltas applies to all stocks, not just to high volatility stocks. What about in a bear market? So in a bear market, you should rethink first whether or not you want that stocks, right? So, that's a question you have to ask yourself. That's a question only you can answer. If you're the type of investor that will hold on to your stocks through bear markets, then yes, you should sell cover calls. But I would argue that perhaps you should rethink whether you should be owning all of your stocks into a bear market. Maybe you should be allocating to something else, cash, treasuries, somewhere where you think the stock is going to increase in value, rather than holding on to stocks that you feel confident that they're going to actually continue to decrease in value. If you had a access to TMX previously, you will continue to have access through our new options play. Nothing changes. Your login remains the same. The place that you go to log in, nothing changes. We purposely made it so that there's a seamless transition from what the TMX version of options play to the new options play Canada. With that covers all the questions that I have time for here today. I want to first of all thank everyone for taking the time out here this afternoon. So many of you have participated in the chat window. I really appreciate you doing that. I'm really looking forward to coming back here next week and showing you the next version of this session and the series. I'm really looking forward again to what we have to share with you coming up with Options Play Canada. So thank you so much, everyone. Have a great afternoon, and I'll see you guys here next week.